Hi, this is Hutch with bankingtruths.com, and today we're going to answer that age-old question of, do I get both the cash value and the death benefit, or do I only get the death benefit and the insurance company makes my cash value disappear when I die? And with IUL, you decide. So with every IUL policy, there's an option 1 death benefit, which is a level death benefit. And if you chose that, then your cash value would essentially be a down payment on your future death benefits. So yes, it would disappear. But option 2 is an increasing death benefit where you get exactly your cash value plus your original death benefit and whatever your cash value has grown to, as long as you keep the option 2 in play. Now, many people choose increasing to level, so option 2 to option 1. They do increasing while they're paying premiums, and then they choose level. They flatten the death benefit when they're done paying premiums, and some people even reduce the death benefit to the lowest possible amount after the 7th year. Why? Because there's no free lunch. You know this in life. Why would it be any different with insurance? So costs are levied on what's called the net amount at risk, and that's the difference between your cash value and the death benefit. So if you keep the death benefit increasing, what's that going to do to your costs? The costs are obviously higher in later years, which is why people flatten or reduce the death benefit. But you get to decide as you go. So to illustrate this, we're actually going to look at 3 workups from the exact same IUL policy. It's a male age 54, preferred plus non-tobacco. We're going to do $18,000 of level premiums into an 8-pay IUL. And then we're going to show option 2 for all of these during the first 8 years. So we're going to show that increasing death benefit for the first 8 years. And then after that, we're going to show increasing, level, and flattening from 9+. And we're going to do so using this Insight software, which is really cool. I love the name Insight because it entails that it's visual, and it is. Rather than pulling up 3 different spreadsheets and showing you different columns of numbers and circling things, which I do quite well, this makes it so easy for me to just overlap 3 different policies that, like I said, for the first 8 years are exactly the same. Their lines are overlapping. So what we have here, this is the death benefit. You can see it grows to $467. It starts out at $330, all 3. And the premium is the exact same. It's $18,000 for 8 years. And so this is the cumulative premium. They're exactly the same. If I get rid of one, the other's right behind it, and so on. But if we focus back on the death benefit, what you're going to see is after the 8th year, we actually have 3 choices. And this is with an index universal life policy. So you have an option 1 death benefit, which is flat, and that would be the green line after year 8. So all 3 of these are increasing for the first 8 years. Then we're going to change from option 2, which is an increasing death benefit, to flat for the green. The blue is going to remain increasing, and the orange, not only are we going to flatten it, but we're going to manually reduce it to the least amount that the IRS will let us reduce it to. So you can see after the next year, one has a death benefit of $473,733, one has $467,000, and one is $242,000. What do you think the impact to cash value is going to be? Well, as you would expect, if we look at this, you can see the orange with the least amount of death benefit starts to pull ahead. And this gets you right up to retirement age. So you can see the one with the most amount of death benefit is a little behind, not too much. The one that we flattened and the one that we reduced is ahead by a pretty good clip. And this really tells the whole story. So you can see we were zoomed in to right about here at 67. When we stretch this out, what you can see is the one that we reduced, the orange, starts to catch up to the green, the one that we flattened. So at age 80, it actually overtakes it. And that's because there was less death benefit the whole time. The cash value was allowed to grow, and it actually pushes the death benefit up. We hit something called corridor, which is the corridor test that the IRS performs, which says the least amount of death benefit you need to have over and above the cash value at any given age. And since there was less drag on the cash, the orange pulls ahead from the green at age 80, and at age 88, it pulls ahead of the increasing. And what we can see is the blue, the increasing, actually tapers off, and we're going to hit this really nasty NA at age 104, and that's because it lapses, which is not pretty. But that's because it was supporting so much more death benefit the whole time. There was erosion from fees on the cash value, and it continued to cannibalize itself to where it couldn't support any death benefit. And obviously, if we go out to 104, not only is there full death benefit, but if we see how much of, let's just take it to a more realistic life expectancy age. At age 90, we have 898 of death benefit from the reduction scenario, and we have 780 in the flat scenario. If we see how much of this is supported by cash value, let's just take it to age 80 or 90s rather. Yep. So I think it was 898. 855 of that is supported by cash value, and that's part of the reason why it's doing really well. There's very little death benefit to assess fees on, even if they are increasing inside of an index universal life policy. And I think it was 750 something and 740 of it. Well, let's just find out. There's 780 of death benefit supported by 743 of cash. Now, again, I love this insight because it is visual, but if I wanted to show clients this in tabular form, I actually have the ability to change my settings and figure out which columns I want to show. Rather than have all these crazy columns, I can just isolate non-guaranteed surrender value, non-guaranteed death benefit. And by just doing that and choosing the years I want, by doing so, I get this nice, clean deliverable here. You still get a lot of clients saying, you know, Hutch, I don't really care about the death benefit. And they say that, but then when they learn that they're missing out on something, it's like, wait, I only get the cash value and the death benefit? But you can see in this gray column just the net surrender value of the increasing death benefit scenario. It grows not quite as much as the flat scenario, but then it does start to get cannibalized, and you can see that here. If we scroll over and just focus on these two, you can see the flattened death benefit, as we saw, grows, but not nearly as much as with the reduced, the one that we reduced after 8 years of increasing premium. And it just makes sense. So I'm going to switch to a single view here. When we look at the single view, and again, this is the increasing death benefit. When we look at this, what's happening is, yes, your death benefit is increasing the whole time, but eventually you hit this spot where the fees are just too much to support this corridor of death benefit. And so it starts to cannibalize the cash, and as a result, the death benefit too. Versus had we just flattened the death benefit right out here after paying the premiums, eventually the cash value catches up to the death benefit and it pushes it up, and even more so or even quicker if we went ahead and reduced the death benefit early on. So can you have the cash value and the death benefit? Absolutely, but it's gonna cost you. If cash value is the most important thing, what we want to do is we want to trim and manicure the policy to make sure that the cash value is going to have the least amount of fee drag, and that's going to be based largely on the amount of death benefit. But you don't even need to decide that now. We're paying premiums for 8 years. Maybe your health changes and you say, you know what, this is plenty of cash value for me. I realize it's not as much. I'm going to have $50,000 less or whatever it was out by age 90. But you know what? I'm willing to do this to have this extra death benefit during my working years or early years in retirement or whatever that looks like for you. Hope this helped to answer that question, and definitely check out the Insight software next time you have a complex analysis case that you're working on.